Something about the silver market right now feels off. Not dramatic off, not conspiracy off. Just the kind of off you only notice if you've watched markets long enough to understand when behavior stops matching logic. The type of movement where the price acts nervously before the crowd even realizes there's a reason to be nervous. And the strange part is, most people won't recognize it while it's happening. They'll recognize it after, when the chart already moved and the explanation suddenly appears everywhere like it was obvious all along. This isn't a prediction video, and it isn't hype. It's preparation. Because silver has a unique personality compared to almost every other asset people trade. It doesn't move cleanly, it doesn't respect confidence, and it doesn't reward people who wait for comfort. Silver rewards people who prepare mentally before the market forces them to react emotionally. Right now, several pieces are lining up at the same time. A seasonal participation gap, a structural feature inside how silver trades, and a recent moment in trading behavior that didn't behave naturally. None of these guarantees a crash or a rally. But together they create conditions where movement can become violent very quickly. The danger is not direction, the danger is surprise. And in silver, surprise is what ruins traders and investors more than being wrong. So instead of trying to guess the future, the goal here is simple. Understand the environment you might be stepping into. Understanding why silver punishes people. Most people don't lose money in silver because they misunderstand economics. They lose because they misunderstand timing. They buy after excitement and sell after fear. They react to headlines rather than positioning. By the time the explanation reaches social media, the move is usually already halfway done. Silver is different from slower assets because its liquidity constantly changes. Sometimes it trades like a deep ocean where massive orders barely cause ripples. Other times, it trades like a shallow pool where even moderate pressure creates waves. The market itself hasn't changed. Participation has. There are periods every year when a large part of the global physical trading activity temporarily slows down. The metal is still there, the contracts still exist, but real-world buying, refining, shipping, and large wholesale movement become quieter for a short stretch of days. During that time, the paper market continues trading at full speed. Futures traders, leveraged positions, NS and algorithms keep interacting, even though part of the real demand side is partially absent. When real participation steps back, but leveraged trading continues, the price becomes easier to push, not permanently, but temporarily. Think of it like steering a car on dry pavement versus wet pavement. The steering wheel still works the same, but the resistance changes. That's what thin participation does to silver. Patterns repeat in markets not because of magic, but because human incentives repeat. When liquidity drops, strategies change. When fewer buyers are standing in the way, aggressive positioning has more impact. This doesn't require manipulation, it only requires imbalance. The two prices of silver. Another reason silver confuses people is that it effectively has two prices at the same time. There is the screen price, the number printed on charts, futures contracts, and trading platforms. Then there's the real-world acquisition price, the amount someone actually pays to obtain physical metal immediately. Those prices move together, but they are not identical. The difference between them is called the premium. When demand for physical metal rise, EAs, or supply tightens, the premium expands. During a calm period, as it shrinks. This creates a psychological trap. The chart can fall while the real-world cost barely changes. To a trader, the market looks weak. To a buyer trying to obtain metal, it doesn't feel weak at all. Both observations are correct because they are observing different layers of the same system. Leveraged markets amplify this difference. Futures contracts allow large exposure with relatively small capital, which means large selling pressure can appear quickly, even if nobody physically owns or moves metal. That speed difference is why silver can sit quietly for hours and then move violently in minutes. The market didn't suddenly become important. Leverage simply expressed itself. And there is another detail most people overlook: margin requirements. When volatility rises, traders need more collateral. When collateral requirements change, positions must shrink. That shrinking looks exactly like conviction selling, even when it's just risk control. A trader can be forced to sell even while still believing the price should go higher long term. This is why sudden drops sometimes happen without news. It isn't always ideology or narrative. Sometimes it's accounting. A strange trading moment. Recently, there was a period during trading where activity became unusually quiet while downward pressure intensified. Normally, when participation drops, price drifts slowly because there is less energy in the system. In this case, the opposite happened. Fewer trades, stronger push. Then, almost abruptly, the price rebounded upward. A single strange moment proves nothing. Markets glitch, liquidity vanishes briefly, orders cluster, but experienced traders treat abnormal behavior as information rather than proof. It's like a warning light in a car. It doesn't mean the engine is destroyed, but ignoring it would be careless. And what matters is not assigning blame, but recognizing stress. Stress in markets shows up before volatility expands. Volatility expands before headlines. By the time explanations arrive, opportunity and danger have already happened. The three forces acting on silver. Silver sits at the intersection of monetary expectations, industrial demand, and geopolitical risk. Each force alone can move the price modestly. Together, they create outsized moves. From a monetary perspective, silver often reacts to expectations about interest rates and currency strength. When investors believe money will remain tight and returns elsewhere look attractive, metals struggle. When expectations shift toward easing conditions, metals attract interest. This reaction can happen even if the long-term story for silver remains strong. At the same time, silver is not purely monetary like gold. It is heavily industrial. It is embedded in electronics, medical technology, advanced materials, and especially energy infrastructure. Large manufacturing demand doesn't disappear just because traders feel bearish for a week. This creates tension between short-term financial positioning and long-term physical consumption. Then there is geopolitics, the unpredictable force. Unexpected conflict, trade disruptions, or energy shocks can instantly alter risk perception. Markets can model economics, but struggle to model sudden uncertainty. When uncertainty spikes, metals often move quickly because they represent tangible value. The important lesson is that silver can have a logical bearish argument and still rally sharply, or a bullish, long-term story and still drop aggressively. The time horizon determines which force dominates possible market behaviors. A realistic negative scenario is straightforward. Reduced participation makes the market thinner. Leveraged selling pushes the price below technical levels. Stops trigger. Traders panic. The decline feeds on itself because falling prices create more selling. The screen shows a heavy supply even if the real-world supply hasn't changed at all. Then participation returns. Buyers see value. Short sellers take profits. Price rebounds, sometimes slowly, sometimes violently. The sharper the shakeout, the sharper the snapback because both sides become trapped. The mistake people make is committing emotionally to only one path. Silver rarely respects certainty. It often performs both moves sequentially. Mindset. Instead of prediction, long-term holders and short-term traders need completely different thinking. A long-term holder survives volatility by accepting it. Daily price swings are noise compared to multi-year positioning. Their biggest risk is emotional decision-making during temporary drops. A trader's survival depends on risk management. Position size and exit planning matter more than direction accuracy. A correct prediction with excessive size can still destroy an account. The critical question is not what will silver do, but what will you do if silver does something uncomfortable? Planning reactions in advance removes emotional decisions later. Write 3 rules for yourself: what you'll do if the price drops, if it moves sideways, and if it rallies. That simple preparation prevents impulsive mistakes when pressure arrives. Paper versus physical reality. Another nuance often ignored is supply behavior. Much silver production comes as a byproduct of mining other metals. That means supply doesn't instantly surge just because price rises. On the demand side, large industrial consumers buy for operational necessity, not speculation. They care about securing material, not market narratives. Because of this, paper selling and tight physical conditions can exist simultaneously. Observers who notice the mismatch aren't crazy. They're watching different layers operating on different timescales. Modern industrial demand, particularly from energy technology expansion, has become significant enough that long-term demand trends remain steady even when market sentiment fluctuates. A frightening candle does not necessarily equal disappearing demand. Staying oriented during volatility. Separate the chart from your goals. The chart shows collective emotion. Your plan should show personal intention. Short-term movements only matter relative to your time horizon. Watch liquidity rather than opinions. Large moves during thin participation carry a different meaning than large moves during heavy volume. The market's ability to absorb orders reveals more truth than commentary. Do not confuse being correct with managing risk correctly. Surviving matters more than predicting. And most importantly, avoid searching for villains. Markets move due to incentives and positioning far more often than coordinated intent. Understanding conditions is more useful than assigning blame. Silver is neither fair nor unfair. It is simply reactive to pressure, participation, and psychology. It can fall sharply even in bullish environments and rise violently in cautious ones. Trying to force certainty onto it leads to frustration. Preparing for multiple outcomes leads to stability. The next movement might be small, or it might be fast and uncomfortable. The point is not guessing which, it is refusing to be surprised by either. If this breakdown helped you understand the market instead of just watching the chart, then support the channel. Subscribe so you don't miss the next analysis, and drop a comment with your own plan. What you'll do if silver drops, stalls, or breaks higher. The more prepared you are before the move, the calmer you'll be during it. I'll see you in the next one.